In 1994, a 24-year-old hedge fund analyst named David Swensen took over Yale's investment fund. Nobody expected much. University endowments were boring, bonds, some stocks, minimal risk. Swensen did something almost nobody else was doing at the time. And over the next 2 decades, Yale's fund grew from roughly $1 billion into over $20 billion. Here's the part almost nobody mentions when they tell that story. For the first several years, the fund barely moved. Small gains, some losses. Nothing that looked like the beginning of a $20 billion story. Ask self-made millionaires what the hardest part of building wealth was, and almost none of them say the first million. They say the first 100,000 pounds, which sounds backwards. Shouldn't every 100,000 pounds be equally hard? Same effort, same amount, same math? It's not. And once you understand why, you'll never look at your bank balance the same way again. Chapter 1. The illusion of slow progress. Nobody dreams about their first 500 pounds. They dream about the house, the early retirement, the freedom. Nobody frames a picture of the month they saved 5,000 pounds. So picture Mike. He starts investing 300 pounds a month. Month 1, nothing. Month 2, still nothing, or close to it. A year later, he checks the number. He's proud and quietly disappointed. He expected more. Here's the uncomfortable truth. This is exactly where most people quietly stop. Not because the investing didn't work, because progress at this stage is almost invisible. And we are wired to expect rewards fast. There's a reason for that wiring. For most of human history, waiting for a delayed reward could mean starving before it ever arrived. Our brains still run on that ancient software, even though the threat today is just a boring bank statement. Bamboo is the plant people reach for to explain this. And for good reason. Chinese bamboo can spend up to 5 years doing almost nothing visible above the ground. Then, once the root system is finally established, it can shoot up dozens of feet in a matter of weeks. It wasn't dormant for 5 years, it was building an invisible root system strong enough to support what came next. Your first 100,000 pounds is the root system. It just doesn't look like one yet. Chapter 2. You're building 2 things at once. Here's what almost nobody tells you about that early, frustrating stage. The money was never the only thing being built. Every time you choose not to spend on impulse, you're rehearsing discipline. Every month you invest on autopilot, even when it feels pointless, you're rehearsing patience. Every market dip you sit through without panic selling, you're rehearsing something psychologists call distress tolerance. These matter more than the number in the account, for one simple reason. Money can be lost. Skills can't. A person who has never built the habit of staying invested through a bad year will very likely panic and sell the moment real money and real fear is on the line. A person who built that muscle slowly on a small account has already rehearsed the hardest part before the stakes got high. The first 100,000 pounds isn't hard because of the number. It's hard because it's where you're quietly built into someone capable of handling the next 900,000 pounds. Chapter 3. Why your money starts doing the work for you. Let's make this concrete, because the abstract version undersells how strange this actually is. Sarah has 5,000 pounds invested. James has 100,000 pounds invested. The market has an ordinary year. Up 10%. Sarah earns 500 pounds. James earns 10,000 pounds. Neither of them worked harder. Neither of them picked a better investment. Same market, same day, same percentage return. The only difference between them is how much money was already sitting there working before the year even started. Here's the number that should genuinely stop you. Once James's pot is large enough, a single average year of growth can be worth more than an entire year of most people's salary, without a single hour of extra work. That's not a hack. That's not luck. That's just what happens once a big enough base exists for a normal return to act on, which is exactly why the first 100,000 pounds is the slowest one. You're the entire engine. There's no base yet for the market to multiply. Chapter 4. The snowball that refuses to roll. Picture the top of a snowy hill. You scoop up a fistful of snow, pack it into a ball, and push it forward. Almost nothing happens. It's small. It's heavy. Pushing it feels disproportionate to how little snow it's picking up. You keep pushing anyway, for what feels like a very long time. Then, without a clear moment where it happens, something shifts. The ball is picking up snow faster than you're pushing it. It doubles. Then, it doubles again. At some point, it's rolling under its own momentum, and stopping it would take more effort than letting it go. This is almost exactly the compound growth curve, flat for years, then bending upward faster than intuition expects. The uncomfortable part, from the outside, the flat section and the exponential section look identical for a long time. You can't tell standing at year 3 whether you're 1 year away from the bend or 10 years away from it. The only way through is to keep pushing without that information. Most people stop pushing exactly there, in the section that looks like it isn't working, one push before it would have started rolling on its own. Chapter 5. The real enemy was never the market. It's tempting to blame inflation, or a small salary, or a bad year in the market. The real obstacle is quieter than all of those, and it's sitting inside your own skull. Behavioral economists have a name for it: present bias. The brain's tendency to weigh an immediate, certain reward far more heavily than a larger reward that's delayed and uncertain, even when the math clearly favors waiting. It's the same wiring that makes people quit gym memberships in February, abandon diets after 2 weeks, and stop learning a language the moment it stops feeling like quick progress. Here's the specific way it shows up with money. An online purchase delivers a reward in seconds. Watching an investment account grow by £27 this month delivers nothing really. No dopamine. No purchase to unwrap. But that invisible £27 is doing something the £30 t-shirt never could. It's laying one more brick under a foundation that, in a decade, will be earning more than your salary on its own. The market was never really the opponent. Your own nervous system's craving for something to feel good about right now was. Chapter 6. The morning. Everything quietly flips. At some point, and it rarely announces itself, something changes. Your investment growth in a single year becomes larger than everything you contributed that year. The first time this happens, you might not even notice. It shows up as a bigger than usual number on a statement, easy to miss, but it repeats. Year after year, the balance shifts a little further. Less of the growth comes from you, more comes from the money already there. Eventually, your portfolio can grow by thousands of pounds in a single year simply because it exists. Not because you added anything at all. Your money has become a second income, one that doesn't take sick days, doesn't ask for a raise, doesn't need managing hour to hour. This is the exact moment wealthy investors are describing when they say the first £100,000 is the hardest. Not because the money got easier to find, because from this point on, they're no longer the only one doing the work. Chapter 7. Why the milestone that matters isn't the one you'd guess. Ask self-made millionaires which number they actually remember celebrating, and it's almost never the first million. It's the first £100,000. Because crossing it proves something no amount of money by itself can prove. It proves you can earn consistently, save consistently, sit through a falling market without selling, ignore 100 more exciting places that money could have gone, month after month, for years. Those are the actual skills that build wealth. The number in the account is just the paper trail those skills leave behind, which is also exactly why the second £100,000 arrives faster. Not because the world got easier, because the version of you that reaches it already survived the hardest part once. People love the idea that wealth comes from one brilliant call, the right stock, the lucky break, the perfect moment. The far less exciting truth is this: wealth is almost always built from very ordinary decisions, repeated for years past the point where they stop feeling rewarding. The first £100,000 isn't hard because of the number. It's hard because that's exactly where most people stop. One push before the snowball would have started rolling on its own. 1 year before the bamboo would have finally broken through the surface. If you're still in that flat, invisible stretch right now, the good news is that it was never a sign it wasn't working. It was the only part where you had to do all the work alone. Everything after this is easier. Not because life gets easier, because your money finally starts working as hard as you do,